Buying stocks at the right price can play a huge role in your overall returns as an investor, and while stocks at a 52-week low don't necessarily mean they're undervalued, it can be a great place to start looking for value. So in this video, we're going to be looking at 5 different dividend stocks that are currently close to their 52-week low. To analyze these stocks, we're going to be using my spreadsheets from tickerdata.com and also using the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet. So let's go ahead and jump into it. And the first dividend stock we're going to look at close to a 52-week low is Intel Corporation, stock ticker INTC, trading at $30.97 per share. Now over the past year, the company is actually slightly up, around 0.65%. But if you look at them over the past 6 months, down 18%. Over the past month, down nearly 20%. Now, what's the reason for this huge decline in their share price? Well, this happened after the company released their latest quarter's earnings report. Now, they actually saw a beat on their bottom line. Q1 non-GAAP earnings per share of 18 cents per share was a beat by around 4 cents, but revenue was up 8.5% year over year, but still missed expectations by around 80 million. Now, investors have a lot of serious concerns with this company, and to name just a few, the company is having some execution risks, which is not the case for some of their peers. They have their spanning extended foundry losses, limited data center AI processor share gains, and elevated China exposure. Now, in a recent report, Intel outlined its path to margin expansion. Why is this a big focus for the company? Well, if we jump over to my profitability spreadsheet, come up here and plug in INTC and hit enter. The first thing you'll notice is yes, earnings per share has decreased dramatically over the past couple of years, but here's what I want to point out in regards to profit ratios. Look at the gross profit ratio over the past decade for this company. For the most part, it was sitting close to around 60% for a good 7 to 8 years, but in the last couple of years, it has really dropped off, going from 55.45% in 2021 all the way down to 42% in 2022, and in 2023, below 40% at 39.72%. And when we look at the revenue versus cost of revenue, it doesn't look good. We can see revenue has actually been decreasing over the past few years, while cost of revenue is still increasing. That is not a good sign for this company. So we can see their 10-year average gross profit ratio sitting at 56.65% and the recent gross profit ratio sitting at 39.72%. So it's no surprise this is something they're definitely trying to work out. Now, if we look at some of the good news surrounding this company, we can see they are on target for their 2025 launch of the Intel 18A CPUs. If we jump over to my stock screener spreadsheet, we'll come up here, plug in INTC and hit enter. And immediately we can see this data load in thanks to ticker data, and there's a couple things we have to point out. If we come over here and look at shares outstanding, we can see for quite some time, the company was buying back shares. It looks like in 2013, they were sitting at about 4.9 billion in shares outstanding, and in 2021, sitting at about 4.05 shares outstanding. But look at this. The past couple of years, shares outstanding have actually been increasing. So the company is issuing new shares to raise capital. But here's where the really big problem is for this company. Yes, we can see there's a huge decline in earnings per share over the past couple of years, but free cash flow per share even went negative in 2022 and 2023. Now, why is this? Well, we have to remember free cash flow per share is net income minus capital expenditures. So let's see what's been going on with their capital expenditures. If we come down here, let's go ahead and pull in all the capital expenditures for INTC as of 2017 for reference to see where they're at. And when this data loads in, we can see capital expenditures was a little bit below 12 billion. Let's see how this trend has changed over the past few years through 2023. And once this data loads in, we can see the problem. 2018, 15 billion, 2019, 16 billion, 2020 a slight decline, but in 2021 it jumped all the way up to 20 billion, and in the past couple of years, capital expenditures have been over 25 billion for this company. So we have to keep in mind capital expenditures have been skyrocketing for this company during a time when revenue per share has been decreasing. That's not a good combination. Now, to be fair, the semiconductor industry is known for having high capital expenditures, but still, Intel has by far the highest capital expenditures when looking at their peers. The only one that even comes close is going to be Micron. Now, if we look at this company from a dividend perspective, we'll come up here, plug in INTC and hit enter. And we can see the company has a low starting dividend yield sitting at 1.61%. Now, here's the problem. If we look at the yearly dividend payouts for this company, we can see from 2013 to 2022, pretty decent dividend growth. But if we come down here and look at the free cash flow versus dividends paid out, the company was not generating enough free cash flow to cover its dividends, and in fact, we can see they had negative free cash flow the past couple of years while still paying out dividends, and the end result of this was the company had to cut their dividend payment in 2023 pretty significantly, going from $1.46 to 74 cents. So that was a pretty significant dividend cut that we saw from this company. And to be honest, if the capital expenditures the company has right now doesn't translate into future profitability, I could see another dividend cut in the future. Our second dividend stock at a 52-week low is Cisco Systems, stock ticker CSCO, and they're currently trading at $47.11 per share, so pretty close to that 52-week low of $45.70. Now again, over the past year, they're actually up around 1.66%, but if we look at them in the past 6 months, down close to 12%, and in the past month alone, down around 3%. Now, something we need to point out about this company, if we look at their upcoming quarter's earnings, we can see announcement date. It's going to be on the 15th of this month, so it's coming up pretty soon. But if we look at the earnings per share revisions in the last 90 days, we have had 12 downward revisions for this company and 0 upward. Not a good sign, so there are some people pretty bearish on the upcoming earnings report when it comes to this company. Now, if we go ahead and jump over to the screener tab, you can see I already plugged in CSCO. And one of the things I noticed when I look at this company, revenue per share really isn't growing at a high rate. In 2013, sitting at about $9.12, 2023 around $13.93. So it has grown some, but a lot of that is due to one thing. They are rapidly buying back their shares. If we look at shares outstanding in 2013, it's sitting at about 5.3 billion, 2023 4.09 billion. So this company has bought back a lot of shares during this time period. So a lot of the growth in earnings per share, revenue per share, and free cash flow per share is simply due to the company buying back a large amount of shares. Now we can also see the debts to asset ratio has been declining during this time period, meaning they have less total debt compared to their total assets. So it's pretty clear two focuses when it comes to their capital allocation plan: buying back shares and paying down debt. We can also see the company has pretty solid return on invested capital, 2023 coming in at about 23.47%. That's typically something you want to see for a company that you're interested in. Now, here's what caught my eye the most when looking at this company. Look at the starting free cash flow yield, sitting at 9.87%. This is a pretty important valuation metric, and that's a pretty high starting free cash flow yield. And all the free cash flow yield is if we look at free cash flow per share, $4.65, and divide it by the current share price of this company, we get the free cash flow yield of around 9.87%. So that basically means for every share you're buying at $47.11, you're getting free cash flow of around $4.65. Again, a very nice free cash flow yield. If we look at the profitability tab and come up here and look at revenue versus cost of revenue, something we just pointed out, again, revenue not really growing at a high rate, but the gross profit ratio is staying steady, something we do like to see. So again, a lot of the growth in the per share metrics is simply coming from the company buying back shares. Now, if we look at our dividend breakdown tab, come up here, plug in CSCO and hit enter. We can see this company has a nice starting dividend yield sitting at 3.4%. So that is above the average starting yield for companies in the S&P 500, and we can see pretty good growth from the yearly dividends. 2013 dividend payouts was around 51 cents per share. 2023 it was $1.55, and with the most recent dividend hike, $1.60. So they have a 10-year dividend CAGR of around 8%. That's pretty decent dividend growth, but the dividend growth has really slowed down over the past few years. We can see the 5-year dividend CAGR for this company sitting at about 3%. So payout ratios look to be in a pretty healthy range. Payout ratio as a result of earnings sitting at 50%, and free cash flow payout ratio 33.10%. So when we look at the free cash flow versus dividends paid, again, free cash flow is easily covering those dividend payments, and in 2023 they generated the most free cash flow ever at close to around $19 billion, with dividends being paid out at around $6.3 billion, which again, that gave them a free cash flow payout ratio of around 33%, which is quite a bit lower than it had been over the past 5, 6, or 7 years, a trend that we like to see. And a big reason for that lower free cash flow payout ratio is, again, that higher free cash flow generated in 2023, and the 5-year free cash flow CAGR sitting at 8.21%. If we look at this company from a dividend discount model perspective, we can see the dividend growth has been a little bit slower over the past few years, like we just pointed out, but moving forward, if they do continue to grow their free cash flow, I think a dividend growth rate is sustainable at around 4.5%. Discount rate of 8% gives us a dividend discount model price per share of around $47.77. Looks like this company might be trading pretty close to fair value, but if they are able to continue to grow their free cash flow, then a dividend growth rate higher than 4.5% could be sustainable, leading to a higher intrinsic value. Our third dividend stock at a 52-week low is CVS Health Corporation, stock ticker CVS, trading at $55.97 per share, and over the past year, down around 19.7%. Year to date, down close to 29%, and look at this, in the past month alone, down 24.44%, and look at this massive drop going from $67 to $68 per share, all the way down to their 52-week low at around $53.70. Now, what was the cause for this drop? Well, the company recently released their latest quarter's earnings. We can see they had misses on the top and bottom lines. Q1 non-GAAP earnings per share of $1.31 was a miss by around 39 cents, so a pretty big miss. And then we saw revenue of $88.4 billion, which was up around 3.7% year over year, but it missed analyst expectations by around $800 million. And the end result of this was CVS Health posted their biggest one-day drop in over a decade after their Q1 miss. So that was a massive drop in their share price. Let's go ahead and jump a little bit deeper into their recent earnings report. And something that I think really caused a huge drop is their forward-looking guidance. If we look back here, we can see on February 7th, they released their guidance for the entire year. And one of the things they said is they were projecting at least $7.06 in earnings per share. That's GAAP earnings per share. But if we look at the recent earnings report, they reduced this all the way down to $5.64. If we look at the adjusted earnings per share, they were projecting $8.30 around a quarter ago. But as of their recent earnings report, it's bumped all the way down to $7 per share. So investors obviously not excited about this forward-looking guidance. Now let's go ahead and jump over to my stock screener tab. Come up here, plug in CVS and hit enter. And what we can see is revenue per share, for example, this has been growing for the company over the past decade. It's gone from around $104 per share up to around $278. So revenue has actually grown quite a bit for this company during this time period, but earnings per share has not grown quite as much. Now it has grown some. It's come from around $3.77 as of 2013, 2023, $6.49, but the growth has clearly not been as consistent as revenue per share. Obviously in 2018, they had a negative year. 2022 was a pretty poor year for the company. But here's my really big concern when looking at this. Look at the return on invested capital in 2023, sitting at just 6.6%. Now, here's why this is a major problem. Most companies have a weighted average cost of capital above 6.6%. We have to keep in mind, if the return on invested capital is higher than the WACC, then that means the company is creating positive value. But if the ROIC is lower than the weighted average cost of capital, that means the company's value is actually declining. So in reality, with a return on invested capital of about 6.6%, it's very likely the company's value is actually declining. They are essentially destroying the company's value. Now, if we jump over to our profitability sheet, again, you'll see something I'm not a huge fan of. First off, again, revenue has grown by quite a bit. That's a good sign. But the gross profit ratios are pretty low for this company. Now, it's not always the worst thing in the world if revenue is growing at a high rate, but in general, I'd like to see better gross profit ratios. So for the past 10 years, the average gross profit ratio is sitting at about 17%. Now, we've seen a little bit of a decline over the past couple of years at about 15.21%. So let's go ahead and jump over to the dividend breakdown tab. I've already plugged in CVS. Now, overall, the company has been growing their dividend, but they did go through a stretch of a few years where they elected not to increase their dividend payouts any. But the past couple of years, they've actually seen pretty decent dividend hikes. They have a 5-year dividend CAGR of about 5.87% and a 10-year of 9.23%. So decent dividend growth during those time periods, and the company has a pretty high starting dividend yield, sitting close to 5% at about 4.75%. Now, if we come down here and look at the free cash flow versus dividends paid for this company, the free cash flow has actually been easily covering those dividend payments since 2019. And we can see in 2023, they generated around $10.4 billion in free cash flow, and the dividends they paid out was around $3.1 billion. So again, that led to a free cash flow payout ratio in 2023 of around 30, and we can see it looks like since around 2019 it's stayed in that 20 to 30% range, which is a very healthy free cash flow payout ratio range. Now again, the question I have for this company is, can they continue to grow free cash flow at a healthy range over the next decade? I think a 10-year free cash flow CAGR of 10.6% is actually pretty healthy for a company like CVS. I'd say it's actually quite good, but I don't know if that's the type of free cash flow growth they'll see moving forward over the next decade. And again, what really scares me about this company is going to be that return on invested capital. I'd have a hard time ever investing into any company that has a return on invested capital as low as 6.6%. Now, if we look at them from a dividend discount model, again, they went a few years without increasing their dividends, but the past few years have been pretty decent dividend hikes for the company. Moving forward, if they can grow their dividend at a rate of around 4% with a discount rate of 8.5%, we come to a dividend discount model price per share of $61.48, which again is a little bit above that current trading price. So yes, it is possible they are slightly undervalued at their current prices, but again, I personally would not be interested in this company due to the return on invested capital. Our fourth dividend stock at a 52-week low is one I've actually never talked about on the channel before, and that is Gaming and Leisure Properties Incorporated, stock ticker GLPI, trading at $43.65 per share. Now, if you watch my channel often, you've probably heard me talk about one of my favorite REITs, Vici Properties, before. This is a real estate investment trust that owns some casinos and gaming properties, and Gaming and Leisure Properties is similar. They own casinos and gaming properties. And like most real estate investment trusts, they have been a victim of the high interest rate environment that's been driving down share prices for a lot of real estate investment trusts. We can see over the past year down around 15%, year to date down around 11.55%, and over over the past month, down around 3.34%. And we can see this company also recently announced their latest quarter's earnings. They announced Q1 FFO of around 92 cents per share, which was a miss by 1 cent, and revenue came in at $376 million, which was up around 6% year over year and was a beat by $7.4 million. Now, if we jump over to the stock screener, there's something I want to point out. We have to remember, this is a real estate investment trust we're talking about. So when we look at shares outstanding, we can see they're increasing by quite a bit. Now, this is typically not something we like to see, but we have to keep in mind with real estate investment trusts, they have to pay out 90% of their earnings in the form of dividends. It's required by law. So really, they don't have a lot of capital left over to reinvest back into the business. So they have two options. They can take out debt or they can issue new shares. And with interest rates being so high right now, debt is probably not the best option. So they are electing to issue new shares. And again, if we look at like 2017 to around 2020, interest rates weren't too high during that time period. So it looks like they were using debt to grow the business during that time period, but they are moving back to issuing new shares. Now, if we look at the company from a dividend perspective, we can see they have a high starting dividend yield sitting at 6.74%. So this is a big dividend payer, no doubt. But when we look at this payout ratio, you might be concerned seeing 113%. Well, that's actually typical for a real estate investment trust. And the real way to judge the safety of these dividend payouts is to look at the AFFO payout ratio. And this is something Ticker Data will incorporate in the near future. But if we jump over to Seeking Alpha, click on dividends, go to dividend safety and start to scroll down, one of the things we can see is right here. AFFO payout ratio for trailing 12 months sitting at about 80% and forward-looking 81.37%. So that dividend payment is covered by their adjusted funds from operation. That is something we have to keep in mind. If we look at a brief company overview, we can see they have real estate in 19 different states and 62 different properties. And if we scroll down, we can see they have some of the top casinos in places like Colorado, Kansas City, St. Louis, Toledo, Columbus, and also the top casino in Baton Rouge. Now, if we look at some of the key characteristics that make a lot of people like this real estate investment trust, look here. GLPI has operated at 100% occupancy since inception, so they aren't having any trouble with their tenants as of right now. But here's the thing, even if they do, in the event a tenant does not elect to renew a lease, lease mechanics provide a time frame for tenants to sell their operating assets without disrupting the lease stream to GLPI or the gaming tax revenue to the host state. So really, there is a layer of security baked into their lease structure. If we look at the dividend discount model, assuming a dividend growth rate of 2.5% and a discount rate of 8.5%, it actually looks like this company is undervalued by around 15%. We come to a fair value of around $50.23 compared to its current price of around $43.70. And then finally, our last dividend stock at a 52-week low, one I covered just a few weeks ago, is going to be Pfizer, stock ticker PFE, trading at $28.16 per share. And over the past year, it's down around 27.18%. Year to date, down around 2.19%, but look at the past month. They're actually up around 5.53%, and this comes after a solid earnings report. We can see Q1 non-GAAP earnings per share of 82 cents was a beat by around 31 cents, so that's a pretty big beat. Now, revenue came in at $14.9 billion, which was down year over year by almost 20%, but it did still beat analyst expectations by around $980 million. So if we go ahead and jump over to our stock screener tab, I've already plugged in PFE. A couple of things we can notice. Revenue per share down pretty considerably in 2023, and earnings per share and free cash flow per share followed in 2023 as well. Not something we like to see, and part of the problem is we can see they are seeing declining gross profit margins by a pretty large amount. That 10-year average gross profit ratio sitting at about 74%, but the gross profit ratio in 2023 was as low as 50%. So that is a very dramatic drop from the 10-year average and the 5-year average of 67.5% as well. Now, if we look at the company from a dividend perspective, I've already plugged in PFE. We can see they have a high starting dividend yield sitting at almost 6%. So this is a pretty big dividend payer, and they have been growing their dividend payments over the past decade, going from around 96 cents per share to $1.64 per share. Their current dividend sitting at $1.68. That gives them a 10-year dividend CAGR of around 5% and a 5-year dividend CAGR of around 3.4%. So overall, solid starting dividend yield, good history of increasing dividends, and decent dividend growth over the past decade, but it has slowed in the past 5 years. Now, here's the problem. Right now, payout ratio sitting at a very unhealthy number, and that's because of the low earnings per share that they reported in 2023. But we can also see in 2023, free cash flow did not cover their dividend payment. So historically speaking, we can see that free cash flow payout ratio sitting around 50%. And during 2021 and 2022, when the company reported very high levels of free cash flow due to the COVID vaccine, that dividend payment was easily covered. But that was not the case in 2023, which should be a pretty big concern for anyone interested in buying Pfizer stock. So the question is, can they get their free cash flow back up to a healthy level and continue to sustain growth with their free cash flow? And anytime we talk about free cash flow growth with any pharmaceutical company, we need to keep in mind what is in their pipeline. It's always about what new drugs do they have in their pipeline. And we can see as of right now, they have about 45 new drugs in the phase 1 level, 28 in phase 2, 37 in phase 3, and 3 currently at the registration level. So that's 113 in total. So there is quite a bit in the pipeline as of right now. But we also need to keep in mind a huge new focus for this company is going to be in oncology. Oncology is typically considered a pretty profitable industry, and they believe that's what's going to drive their growth moving forward 2024 and beyond. So if we scroll down to the 15th slide of this investor's presentation, again, you can see they recently acquired Seagen. This is an oncology company. And I believe the hope is this will be a huge driver of growth for them in the near future. Now, when looking at Pfizer from a dividend discount perspective, if we assume a dividend growth rate of around 2.75%, which is pretty close to the historic average over the past few years, discount rate of 8%, we come to a dividend discount model price per share of $32.88, a decent bit above that current trading price by around 16.76%. But there you go, those are 5 dividend stocks currently trading right at their 52-week low. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.